S&P 500 has largely recovered the losses caused by Trump's tariff policies. We're nearly halfway through 2025 and S&P 500 is up 0.74% year to date, pushing it slightly in positive territory. Even though it's positive year to date, it's still underperforming the global market by 12% so far in 2025. It's the worst start to date relative to the world since 1993. This comparison is based on MSCI All Country World Index excluding US. This makes sense as balance of payment theory suggests that when US is expected to import less due to tariff, the balance of current account increases. This typically leads to capital outflow, meaning money exits both the US equity and bond market. So the behavior makes sense logically. Although it seems a few days ago Trump's trade strategy was working successfully, bringing China and EU, world's two largest economies outside of US, to the negotiation table, boosting market confidence, but the situation has become bumpier, especially with China. Recent US actions, such as revoking some Chinese student visas, banning exports of chip design softwares and certain jet engine parts to China, and restricting Huawei from selling advanced AI chip globally, has angered China. Trump has noted that China has not lifted its rare earth mineral export control to the US, despite having promised to do so in early negotiation in Geneva. In response, Trump is doubling its tariff on imported steel and aluminum, increased them from 25% to 50%. However, this move isn't limited to China, so it applies to all countries. So as a result, Canada, as the largest exporter of steel and aluminum to the US, is being hit the hardest by the tariff increase. Treasury Secretary Scott Bessent stated that talks with China are somewhat stalled and emphasized that personal involvement from both countries' leaders is essential in the upcoming weeks. However, despite Trump expressing interest in meeting Xi Jinping since the start of his second term, nearly 5 months have passed without any meetings, so making it unclear why Bessent expect this to happen very soon. It seems like the future negotiations between US and China are going to be bumpy, very treacherous, with significant uncertainties ahead. So this will likely lead to increased volatility in the stock market, which could ultimately create potential buying opportunities. The economic volatility is already evident in US import data. In April, US goods imported dropped 20% as tariff policy began to take effect. In this chart, dark blue line represents US import in the month of April. Light blue line represents US import in March. And every category is being listed here. The US-China decoupling began in early April. The Liberation Day was April 2nd, and China retaliated right after it. And both countries essentially decoupled with tariff above 100%. And the pause of the tariff actually happened on May 12th, meaning that the entire month of April is pretty much reflecting the full impact of decoupling between US and China. There is a development that's not being widely covered by the mainstream media, but is already flagged by some of the Wall Street firms. It's so-called Donald Trump's nuclear-grade trade war weapon, expected to debut soon. Of course, when the act passes, it's the Section 899 of the so-called One Big Beautiful Bill Act, which is the major piece of legislation introduced by Trump's second term, and it has already passed in the House and is currently under Senate review. So Section 899 is the important thing. It gives Donald Trump another tool to fight the trade wars. This would allow U.S. to weaponize its capital market by imposing taxes on revenues generated by foreign holdings of U.S. assets. So if the bill gets passed and Section 899 is enacted, it would give U.S. a powerful new tool to pressure foreign countries during future trade conflicts, or even when Trump try to get countries to negotiate with U.S. So the measure is designed to target so-called discriminatory nations, so nations that impose digital services tax on U.S. tech giants like Google, Apple, Facebook, Amazon. This includes many countries in Europe, right? Those countries, they impose a tax on these U.S. tech giants' revenue on their country. Okay, so while China doesn't currently have such tax on U.S. tech giants, the Treasury has broad discretion to label countries as discriminatory based on the broader trade practices. For instance, although China doesn't deploy this sort of digital tax, but they restrict American services companies from even operating domestically. A lot of American social media apps are blocked in China, right? Which could qualify China as discriminatory. So essentially, almost any country could potentially be classified as a discriminatory nation under this framework. So once the bill is signed into a law, it would equip Trump with a new weapon, right? A nuclear grade trade weapon alongside the current tariff weapon, increasing the leverage and ability to exert pressure on foreign nations. Currently, there's around $31 trillion in foreign held US asset, and they could be at risk under Section 899. I think this Section 899 could be acting as a double-edged sword because while tariffs are aiming to punish countries with trade surpluses against US, Section 899 targets nations that invest in US assets, potentially harming key investors in American economy. I don't understand why you would want to punish people who invest money into your country. If you think about it, one of Donald Trump's main goal in his current negotiation is to encourage companies to invest and build in America, to make America great again. Trump always tell foreign manufacturers to build up factories in America. If it's made in America, their product can be sold in America without tariffs, right? That's one thing he always pushed for. But now, if you think about it, he's now introduced a law that could actually hurt those initiatives. It would hurt those foreign investors, which goes against what Trump is trying to achieve. Also, if the tool is not used cautiously, it could backfire. Many nations is already skeptical of the U.S. dollar, especially the countries with anti-American sentiment, like the members of the BRICS. Those countries have spent the past decade reducing their dollar exposure, exchanging their dollar with gold, with physical gold as an alternative reserve. So the aggressive use of this new tool could accelerate global de-dollarization effort, undermining the long-term dominance of US dollar in the international finance. Thank you very much. Please like and subscribe.